In this video, I'll be discussing accounting for revenues. There are two types of revenues we'll be focusing on. The first one is revenues generated at the point of sale. The second one is revenues that are deferred. And let's start with a simple sales transaction, shall we? Let's assume that a customer pays $10,000 for a product and receives the product. This is like a customer going to a retail store and paying money to receive the product. A sales transaction has two parts. The first is the revenue part, relating to the inflow of assets to the firm, that is, the customer pays cash or there is a promise to pay. The second part is the expense part, relates to the outflow of assets, where the firm delivers the goods and the customer receives the goods, but we'll ignore this expense part for now. So going back to the transaction, what are the effects on the balance sheet equation? Cash has come into the firm, so asset side of the balance sheet goes up by $10,000. At the same time, the firm has generated value, so equity goes up by $10,000 as well. What type of equity goes up? The retained earnings goes up. Why does retained earnings go up? Because a firm has generated revenues, which creates net income that in turn feeds into retained earnings. Now let's turn the dial a little bit. What if a customer buys on credit? Consider a sale of $100,000 worth of products with a promise to pay later. So let's look at the effects on the balance sheet equation. No cash has come into the firm, but there is a promise to pay, which means the customer owes the company $100,000. So there's an accounts receivable for the firm of $100,000. So there is an implicit asset on the balance sheet. Now also note that the value has been created by the sale, so equity goes up by $100,000, representing what? You got that, retained earnings. Why? It generates revenues, it creates net income, and that feeds into the retained earnings at the end of the year. Now let's look at the cash receipts from customers. Now this customer who has received the goods and promised to pay, let's assume this customer pays $50,000 in cash. What are the effects on the balance sheet equation? Now clearly when there is cash coming in, cash has gone up by $50,000, so assets gone up by $50,000. And notice that there is no value created in this transaction because the sales has already been completed before. Now, but the obligation on the part of the customer has gone down because the customer owes us $100,000, they've already paid $50,000, so the accounts receivable will go down by $50,000. Now the balance sheet balances, but notice that all the effects are on one side of the equation, the asset side of the equation. But 0 equals 0, so the balance sheet balances. Again, as I said before, there are no effects on the income statement because the value was created at the time of sale. Let's look at the summary of the accounts receivable account at the end of the year. Let's assume that these are the transactions that occurred. Accounts receivable, or AR for short, is an asset. That's why it's represented as A in parentheses. The accounts receivable has a beginning balance of $0. New sales were generated $100,000. Cash was received of $50,000. So the amount at the ending balance of the year is $50,000, which represents the amount owed by the customer at the end of the year. Now let's move to a different transaction. What if a customer pays in advance? Let's assume that a customer pays $100,000 in advance for a subsequent product delivery. What are the effects on the balance sheet equation? Now again, cash has come into the firm, so assets go up by $100,000, but has any value been created? Not yet, because no product has been delivered. But we have an obligation to serve this customer. So liabilities go up by $100,000, and what do we want to call it? It's usually called deferred revenue. So we have an obligation to deliver the goods at some point in time in the future. If we don't deliver the goods, we have to pay back the money. So that's the obligation. And sometimes this deferred revenue is also called unearned revenue. Again, here, there's no effect on the income statement because the firm has not provided the goods or delivered the goods yet, at which time the value will be created. Let's assume that the product delivery occurs at some point in time in the future. Let's assume if the company delivers $40,000 worth of goods, a partial delivery, at which time the accountant will record the transaction. So what are the effects on the balance sheet equation? Now, $40,000 worth of goods created value for the firm, but no asset has come into the firm at this point in time, but clearly we have discharged our obligations as the firm from the point of view of the firm. So the deferred revenue goes down by $40,000. Now, the firm has generated revenue or created value for $40,000. So equity goes up by $40,000, which will again come from the income statement because the firm has generated revenues, which feeds into income, and again, that feeds into the retained earnings. Now let's summarize the transactions relating to deferred revenues. Recall that the deferred revenue is a liability account, or unearned revenues as it's sometimes called. We have a beginning balance of 0. The firm received cash worth $100,000. And at some point in time during the year, the firm also delivered $40,000 worth of goods. So the ending balance is $60,000. What does the $60,000 represent? It represents the amount of products that have not yet been delivered. And the hope is that the company will deliver it at some point in time in the future. So let's summarize the income statement effects for this particular company during the year. And we'll summarize all the revenue transactions that have occurred during the year. So what are the 3 revenue transactions? First is the cash sales. That's the first transaction of $10,000. Second is the credit sales of $100,000 for which the customer promised to pay. The third is the deferred revenues on which we have supplied, the firm has supplied $40,000 worth of goods. So the total revenues in this particular instance is $1,040, so total is $150,000 worth of revenues that will be recorded in the income statement. Now let's summarize the balance sheet effects. What are the key effects on the balance sheet? We know that the company has accounts receivable on the balance sheet for $50,000 because the customer still has to pay us $50,000 for the products that were delivered. In addition, there is also a liability of $60,000 on the part of the firm because the firm has to deliver goods worth $60,000. Now you may say the balance sheet is not balancing because there seems to be a disconnect with the asset side and the liability side. But notice, this is only a partial representation of the balance sheet. There are other items on the balance sheet that are not discussed here. This summarizes our video.